Hello, welcome everybody. My name is Fabio Petti. I'm a Deputy Head of Group Investment Strategy. I'm here together with Marco Valli, our Chief Economist, and Alessandro Caviglia, our Chief Investment Officer for Italy. We just finished our Group Investment Committee where we discussed the key structural changes that are affecting the global economy, starting from the US shift. We are seeing this through the level of the US Treasury on a 10-year, but also on a 30 years. The role of the US dollar is now challenged and potentially will change in the coming future. And underneath, we have all the discussion related to tariffs that are affecting the global commercial and the global economy. So, Marco, I would start with the US economy, and I would ask you, can you give us the key reference point on your baseline scenario as far as the US economy is concerned? GDP growth, inflation rate, and then ultimately, what do you expect from the Federal Reserve in the coming 12 months?
Yes, the US economy is clearly slowing down, right? From last year, where growth was well above 2%, we project growth for this year at around 1.5%. The growth rate of the first quarter was slightly negative, which I think is probably an overestimation of the intensity of the deterioration in the business cycle, because there was a very strong increase in imports due to some front-loading effect before the implementation of tariffs. So this will most likely reverse in the coming quarters, while in the first quarter, domestic demand held up quite well. So going forward, I would expect, let's say, a reversal of the front-loading effect and a slowdown in the domestic driver of growth, particularly consumption and investment. So this will take us on a trajectory of positive, but below potential expansion in activity. One important assumption that we make is that the labor market will hold up. And this is obviously critical when it comes to implications for monetary policy. So yes, we do see a meaningful slowdown in the pace of new hiring, but the uptick in the unemployment rate, I think, will remain relatively contained, because companies, first of all, will be reluctant to fire people. They still remember probably the difficulty they had in trying to rehiring people after COVID, right? And so they're probably more reluctant to lay off people in this business cycle compared to the past, also because of demographic shifts and changes. And second, because Trump's immigration policies is reducing the growth rate of the labor force. So this will limit the upside for the unemployment rate. And the implications, I think, are important when it comes to the outlook for monetary policy. How do we see the Fed in the current environment where growth is slowing down and the inflation will accelerate due to the tariffs in the second half of the year? Because up to now, companies have been able to delay the time when they start repricing their goods, because they have the high level of inventories, which act as a sort of buffer. But this effect cannot last for too long, and therefore inflation will definitely accelerate in the second half of the year, reaching probably levels above 3%. Right? So what does the Fed do in this environment? If we are right in thinking that the business cycle is not heading for a hard landing and the labor market is set to hold up, then I think the Fed will be very careful to the inflation side of its mandate, particularly inflation expectation. And we think that they will cut, but they will cut rates less than the market is currently predicting. So we have only one cut by the end of this year, and another cut sometime around the mid of 2026. Let me conclude with a short remark on public finances, because the tax bill that has just been passed by the House does nothing to put the deficit on a sustainable trajectory. Right? In our forecast, actually, we have the deficit rising further from last year. The general government deficit was just above 7%. We are going to approach 8% this year and in 2026. So definitely this is not putting public finances in the US in a good place. And I think that this will have also important implication when it comes to our asset allocation.
Yes, indeed, Marco. This is something that we'll discuss with Alessandro. I think it's super important and already visible in the trajectory also of the US Treasury. Before going to the investment part, maybe just a few words on your side on the expectation regarding the Eurozone and the European Central Bank projection.
Yes, also in Europe, in the euro area, growth is projected to slow on a quarterly basis. In yearly average terms, it will be just below 1% for this year and around 1% for 26. We see the bulk of the tariff-related drag on activity materializing in the second half of the year. So in the first few months, exporters have been able to enjoy strong demand coming from the US in anticipation of tariff, but that obviously will reverse. So we assume that in the second half of the year, the tariffs will let's say, lead to the biggest hit to economic activity. The labor market, I think, will also deteriorate, but to a moderate extent, and overall we will not see a downturn in the labor market, which is important to limit the downside risks. Other sources of mitigation of the shock come from private consumption, benefiting from improving real disposable income, acceleration in the growth impulse of NGU investment, and rate cuts by the ECB. Inflation in the Eurozone has already converged to 2%, and I think it will stay there for the foreseeable future, because trade war in Europe, at least in the short to medium term, is disinflationary due to weaker growth, due to FX appreciation, due to lower energy prices, and due to potential trade diversion of Chinese goods away from the US into alternative markets, including Europe, which means that the ECB has further room to cut interest rate. We see a rate cut this week to 2%, and probably by the end of the summer, we will be going down to 1.75%.
Okay, super clear. So, Alessandro, the economy that Marco depicted is basically no recession on both sides of the ocean, with US growing around 1.5%, lower growth in Europe around 0.9%, 1%, inflation higher in US around 3% and around 2% in Europe. Big caveat regarding the deficit trajectory of the US economy, and as a consequence, potential implication first on the fixed income market in US and then potentially also on the equity market. How do we react, and what's the asset allocation that you would suggest in that situation?
Well, on the fixed income side, we have both confirmation and some relevant change. Confirmation regards basically what we call our euro quality carry strategy. So basically, since it's quite clear the Eurozone inflation and ECB pattern, we continue to build our fixed income portfolios with a bulk allocation to euro government bond and euro corporate investment grade bonds. We have seen during April turmoil, they provided support to our portfolios. They are contributing positively to the current fixed income portfolio returns, and they have a very high quality, safe, secure, average credit quality. We also have some satellite positions on emerging market debt in hard currency, so in US dollar and euro, but when we invest in this asset class in US dollar, we fully hedge the currency risk. And here comes the relevant changes, because obviously we have to live in a world with a high level of uncertainty with regard to medium, long-term effect of the Trump policies. And basically what we can imagine, a higher level of inflation in the second half, and this will generate probably a higher level of the Treasury yield curve. Also, an additional negative factor is the persistent budget, which will lead to higher level of debt, to higher financing needs. And then we have also to consider the investment policies of the main sovereign wealth fund around the world, of the biggest Asian central banks, which in the current period of deglobalization are trying to diversify their assets away from, let's say, the traditional US safe haven. And so they are trying to reduce their exposure to US treasuries. Obviously, deglobalization means also a little bit of de-dollarization process. We think it will be a slow, moderate process because obviously US dollar is the main reference currency for world financial markets, international trade, global payments. But we think that this process is ongoing. In April, we had an equity market correction, a spike in treasury yields, and in the past, these elements were strongly in favor of a US dollar appreciation. We had the opposite. So the US dollar depreciated. And this because those forces, those deglobalization and de-dollarization forces are still here, and we think they will not disappear in the coming quarters.
Very clear. One of the things that Alessandro mentioned is the deglobalization. And ultimately, this has been triggered by the tariff war that the new administration is setting against many of the other nations. What is, Marco, in your baseline scenario, the lending level that we may expect?
Yeah, I think it's reasonable to assume that 10% will be the new normal for tariffs for almost all the trading partners of the US. China would most probably have a higher level of tariffs, something which is maybe around the current 30% or potentially even higher if negotiations are not fully satisfying for Trump. And for Europe and for the Eurozone, I think we should assume that the landing point will be around 10%, maybe slightly higher, but definitely we think it will be lower than the original 20% tariff that Trump imposed on infamous Liberation Day. Negotiations may take a bit longer than for other trading partners because I think it's going to be tricky to find the right balance between the request and the offers of Trump and Europe. But ultimately, I think, in our baseline scenario, we assume that tariffs will be closer to 10% than to 20% when it comes to the sort of steady state new normal.
Thank you. Alessandro, then as a consequence, this calls for a very important selection process in our equity portfolios and a clear view on which sector do we want mostly to bet on. Which is our current stance?
Yeah. Basically, we continue to build global portfolios when it comes to equity. Global portfolio means that US currently weighs more or less 60% of our global allocation. And then we have 20% allocated to Europe, 20% allocated to emerging markets. Where we take much more active bets are on the selection of the companies, the industries, the themes. For example, in Europe, we are maintaining a strong allocation to financials because in this historical period, banks shows strong balance sheet, strong capital position. Industrials will benefit from the fiscal expansion in Germany. When we invest in the US, we still think technology is the long-term investment theme. Obviously, we are aware of the concentration issue on the mega cap. That's why we build a portfolio, a tech portfolio within the portfolio in order to limit the single name exposure. That said, we have also positions on what we call diversifiers. For example, utilities, industrials, because anyway, those companies will benefit from the technology and energy transition and also on the reshoring process, which will favor the US companies. Again, since we are issuing a cautious note on treasuries and US dollar, also when we invest in US equity, we cover partly the currency risk.
Thank you so much, Alessandro. Thank you, Marco. I think we are ending our video now. We'll see you on the next one. Thank you so much.